Hello everyone, welcome back to the channel. Today we are diving into the world of financial economics to tackle one of the most critical topics for traders and risk managers, the model building approach to value at risk. If you are ever wondered how big banks and portfolio managers quantify their potential losses during a market crash, this video is for you. We are going to break down how to measure volatility, scale it across time and see how diversification actually saves you money. Let's get into it. Before we can calculate risk, we need to understand our building blocks. In the model building approach, which is a powerful alternative to historical simulation, we focus on risk factors and volatility. One thing that surprises people new to the units, we don't usually talk in the annual terms here. Instead, volatility is typically quoted as volatility per day. To make this work, we follow a core assumption. We assume that daily percentage changes in asset prices follow a normal distribution with a mean of 0. Our ultimate objective to estimate the standard deviation of the change in a portfolio's value over a specific time horizon. If we want to move from a daily view to an annual view, we use the scaling rule formula to convert that volatility. In the single asset case, let's look at a real world example using Microsoft. Imagine you have a 10 million position in Microsoft shares. You want to know your risk over a 10-day time horizon with a 99% confidence interval. Here is how the math breaks down. Microsoft's daily volatility is 2%, which means our daily standard deviation in dollar terms is $2 lakh. To get 1 day VAR at a 99% confidence interval, we use a Z-score of 2.326. Multiply that by our standard deviation gives us $4,65,300. But we need to know the 10-day risk. To find that, we use time scaling, multiply the day VAR by root 10. Here the result is $14,71,300. In the two asset case and correlation, what happens when we add more to the mix? Let's expand the portfolio by adding $5 million in AT&T shares. Now you might think you just add the risk. Wrong. Risk is not the simple sum because we have to account the correlation between assets. If these two have a correlation of 0.3, the combined daily standard deviation for the portfolio is $2,20,200. The combined 10 to 99% VAR for this diversified portfolio comes out $16,20,100. Here the benefits of diversification, this is where it gets interesting. Let's look at the gain from diversification. The 10-day VAR for Microsoft alone was $14,71,300 and for AT&T alone it was $3,67,800. If we just added them, the total risk would like $18,39,100. But because the actual portfolio VAR is only $16,20,100. In the specific scenario, diversification reduced our potential losses by $2,19,000. Here the assets are not perfectly correlated. You will always see some risk reduction. In the expected shortfall calculation slide, finally we have to talk about the limitation of the VAR. VAR asks how bad it can be, but it doesn't tell us what happens when we exceed that limit. That's where expected shortfall comes in. Expected shortfall asks if things go wrong, we hit that 1% tail. Because it looks the average of those extreme tail losses, ES is always greater than VAR. For the combined portfolio, the 10-day 99% ES jumps to $18,56,100.